Well, good morning, John. It's good to see you. We are recording this on Thursday morning. An interesting period over the last few days in Australia. We had the CPI number, which kind of jarred a little bit, came in higher than expectations, and all of a sudden I'm reading headlines in the Fin Review saying rate cuts off the table. I'm not quite sure I agree with that, but John, how do you see it?
Well, I think it's going to slow the rate cuts. I don't think they're off the table. I think we're suggesting another 0.5% by middle of next year, maybe one before Christmas and one before the first quarter of next year. But it depends not only on the inflation readings, there's employment numbers we've got to watch, GDP numbers, and then we've got to watch what happens in America in terms of the Federal Reserve and their interest rate policy, because we've been saying for months, Paul, that it's hard for the Australian Central Bank to cut aggressively before the US Central Bank cuts. And Jerome Powell's, I think, suggesting that there may be more cuts in America, but he's not rushing. He's not rushing to do it. He wants to see more evidence that regarding inflation and the effect of tariffs.
Is it a case, John, that bad news on the labour front is good news for the markets?
Well, it'll be good news for interest rate cuts. It's short-term trading opportunity. I guess the traders jump on the bandwagon and start buying on the likelihood of interest rate cuts. But it's not supported by earnings. But that's the whole market, Paul. There's lots of empirical evidence now, when we look at PEs and earnings growth in Australia, the expansion of the Australian share market, the increase in market capitalisation, the price-earnings ratio expansion, the slow growth in earnings. So we've got very, very high historical Ps in Australia. That's all driven by interest rates. It's not driven by, economic reality or profit reality. Saw an interesting comment last night. I think over the last 10 years in the ASX 100, there's only about 8 companies which have been able to compound earnings by 10% over that 10-year period.
That's an extraordinary small number, isn't it?
Correct. That means those companies have doubled their profits plus some over the last 10 years. Yet the share market analysts, the forecast suggests over the next 3 years, 44% of companies will compound earnings by 10% per annum. So you see, historical reality says it's going to be very hard. I know there was a COVID period in the middle, but we did get inflation, and inflation tends to push profits up, as we know. So expectations in the market against historical reality, and it's not long-term, it's not way back in the distant past, it's only in the last decade. The market remains bullish on earnings in Australia, yet there's no evidence that should be so bullish.
Yeah, so the one lever that there might be there are the big resource companies which are trading on fairly low multiples at the moment. And, overnight we saw a 3% jump in copper, and we're seeing stronger prices for BHP, Rio today, and some of the small copper miners. Is that the opportunity in the Australian market? Because it's hard to see serious double-digit earnings growth from, the banking sector.
Yeah, look, I think the metals and the resources sector look okay. I mean, in terms of Australia's earnings, and you're watching what's going on in the UN and what's going on the side of the UN, and we had China this morning saying they're going to cut emissions by 7 or 10% by 2035 from their peak. There's a lot of words there, but they were talking about substantial investment in wind farms and solar, which is interesting. So every time you expand energy production, it is economic activity which is driving usage of metals. Whether you're talking copper, aluminium, or steel, these are all drivers and maintain the demand for Australia's exports. And you've got Europe with their requirement, as we've talked about, increasing defence expenditure. That's all good industrial demand for metals and bulk commodities. So I agree with you, Paul. I think, investing today is very much about indexing, and then you've got to somehow get reality into the index and get performance into stocks which are clearly better value than overvalued in Australia financial companies, so to speak. So we've got two big sectors. We've got the resources sector. We've got the banking financial sector. What I see is I think the banking financial sector is very fully priced, and if this share market's going to sustain itself, it's got to be in the commodities and metals area.
Yes, you spoke about two of the supportive legs on that stool, which is the energy transition and rearmament and reindustrialization, I suppose, to some extent in Europe. You didn't mention the data centers and the growth of AI, which obviously another huge leg.
Investment. And it's what is becoming apparent. There's a huge usage of energy as well. So it's going to put tremendous pressure on the Western world to develop more sustainable energy at a reasonable cost. Australia, as we know, sits on the sidelines regarding our zero policy. We're less than 1% of world energy. We export to the world. We've got tremendous resources in terms of uranium. At some point, we've got to connect the opportunity in Australia to build clean energy as well as nuclear. In the recent visit, and I don't think it's been well reported, Paul, in Australia, and I don't know why, but whether you like Trump or not, he went to the UK, had a visit with King Charles and spent a couple of days doing deals. I think there's 6 or 7 small nuclear reactors being agreed upon between UK and America. American technology, UK development. 6 or 7 small nuclear reactors. China this morning is saying they're going to push more into nuclear energy and driving clean energy production. What is Australia doing? It is beyond belief. Unfortunately, it's become a political argument, not a logical argument, and it took over the last elections as we know, and it lost the Liberal Party the election. But was nuclear properly debated? And we seem to be able to develop, or we think we can develop 2050 plans for energy. We think we can do 30-year plans for submarines, but we can't have a 20-year vision to build some sort of nuclear network in this country, even though we have 30% of the world's reserves of uranium. The solutions for energy in Australia are multifaceted, and I don't know why we close off anything.
Yeah.
And we should go for the best, and we should go for the most efficient and the best sustainable solution, not detail stuff. But that's where we're at present, I think.
Yeah. Just want to come back to that overnight move in copper. Apparently it was caused because Freeport McMoran, which operates the Grasberg mine in Indonesia, declared a force majeure because of a mudslide. They're the second largest producer of copper in the world. And why I'm so bullish these industrial metals is because it really takes at least 10 years to get a mine off the ground virtually anywhere in the world. So there is a supply disruption, and it's very difficult getting new supply onto the market.
Yeah, and I think that's why we're seeing copper sitting in the mid $4 an ounce. I mean, for a long, long time it was around $3.
Yeah.
And now it's $4.50 US. I mean, and it's sustained.
Yeah.
And I think it's creeping up on the market. BHP and Rio, and I guess Newmont to an extent, they're these diversified miners, and they're big and they're well capitalised. Have got reasonable copper earnings coming through, and to supplement their other businesses. So I think it'll become a reasonable export income generator for Australia as well, which is good.
Yeah. Let's switch ground, John. We've been reading in the last couple of days in the financial press here in Australia about ASIC being busy. I think Macquarie's done a deal with ASIC to repay Shield trust investors, something like 321 million. ASIC has put some sort of stop on Latrobe funds, but now seems to be reversing that. Are you confident with the regulation of the industry in Australia? And is ASIC tough enough or too tough?
Well, we can debate that, and it's about focus. I mean, it's good. Let's be reasonable here. It's good that Macquarie Bank has admitted mistakes and have come to the party as a big institution with a big brand and goodwill in the marketplace with the broader Australian population. Have come to the conclusion to put the money in the pot. It is an administration they're taking over, I suspect. So Shield is an administration. First Guardian seems like a complete mess, but they're not exposed there. So we need to understand that. So this is a more workable solution in the Shield Trust than it is in the First Guardian. So good news there. And I just hope ASIC drives to get the money in the investors' hands as quickly as possible before they worry about, who are the culprits, who is responsible, because it seems to me, the real culpability is at the funds management level, but that's for the courts to decide. First Guardian, on the other hand, is a complete mess, and I don't think it's going to be as easy for investors there to get their money out, or get their money back, or to get some recompense. I'm of the view, get the money back to the investor as soon as possible, make them whole as soon as possible, because every day you wait, they're losing compound returns in their superannuation funds. So it's very, very important. There's also hideous effects on people's health and their mental stress. It's just not fair. Now, the compensation is a great debate. Our managing director, Michael, wrote an article recently in First Things, published it. We think there should be a superannuation levy on all superannuation funds. It wouldn't have to be much. Once it got to about $1 billion, it could just sit there as a reserve. It's almost like an insurance policy for all insurance funds, whether they're self-directed or APRA regulated. Let's be clear, there's been issues right across the industry. It's not only in the super fund sector or the direct investor sector, it's also been in the industry fund sector. There's claims there as well about service levels. So I think a general reserve would be good. Stop hitting the advisors. I think if we read the evidence coming through today, a lot of articles in this Fin Review, is it really the fault of the advisors? I don't think that's shown at all. These funds were sitting on platforms, rated, they had RE oversight, and they essentially were not the funds that were promoted through their PDSs. I guess this is ASIC's way of saying, well, look, we oversee the industry. We don't regulate every document that goes out there. So I think also investors would be surprised by that they think that there is some oversight by ASIC in some of these PDSs, but it's obviously not as strong as probably the marketplace thinks.
Yeah. John, we've probably got time for just one more question. I think while we've been recording this video, Prime Minister Albanese been addressing the United Nations General Assembly, so we've missed that. But I'll watch the recording. You would have watched Trump addressing the General Assembly. Did you have any thoughts on that and the relevance of the United Nations at this point in our history?
Yeah, look, it's like I always have the view about Donald Trump that 50% of what he says is, factual, reasonable, to the point and worth debating, and 50% is unfortunately thought bubbles, and they, like all thought bubbles with no substance, they just burst and disappear over time. So you've sort of got to take it on that basis. I think you obviously wanted to front the United Nations and sort of suggest to them that they weren't doing a great job. He talked about wars, and I don't want to put too much credence on his ability to save wars, and he's failed greatly in Ukraine. But I think some of the things he said, that the United Nations should be stronger. They should be stronger, and they should seek resolutions. And, great debate about Gaza. I think it would have been better if the United Nations demanded the release of the hostages. That would have been a great start before you talk about any other solution. But that's not being done, and it just labours on.
John, you are going to be giving a presentation in Brisbane. Do you want to tell people about that?
Yeah, well, it's a good opportunity. I mean, we're up there on Thursday the 16th, so anyone who's interested in coming, look out for our advertisement on our website or through our videos. There'll be a chance to put your name down and come along. So it's on Thursday the 16th of October, so in a few weeks' time. So look out for that. But it's generally talking about macro effects on asset allocation, markets, likely returns, You certainly will be talking about quantitative easing, which I see is a big issue for the world in 2026, what that means for markets. And we've been talking about it all, but I'll go into greater detail. And our Chief Investment Officer, Leo Economies, will be with me, so it'll be a good opportunity to meet him.
Yeah. Good. Well, I think we'll leave it there, John. Lots to think about, as always, and we will see you next week.
See you then.